In Chapter 9, we're going to look more closely into the accounting for current liabilities. And the idea of liabilities and current versus long-term liabilities is not new, but we're going to go ahead and refresh that definition. Remember, a liability is an obligation that a company has some type of future sacrifice that is due to something that has already occurred, so due to some type of past event. As we've already talked about in this class, we have both current liabilities and we have non-current or long-term liabilities. The difference there is current liabilities are liabilities that we expect to have that sacrifice or that payment to come up within the next year or operating cycle. Whereas a long-term, you're not expected to have a payment or a sacrifice that has to be made for over a year. So that's our basic definition between the two. Now, we haven't really talked about uncertainty in liabilities yet, although we have talked about liabilities. But from this point forward, we're going to begin looking at different types of liabilities, and we're going to classify those into what we talk about as known liabilities, and then unknown or estimated type liabilities, and those have a portion of uncertainty to them. And that's what we're going to look at. So anytime we're talking about known versus unknown liabilities, the unknown element that we're talking about could be that we simply don't know who we need to pay, when we need to pay, or how much we'll actually pay. And we'll look at those as we move into our estimated liabilities. But first we're going to concentrate on our known liabilities. And everything that we've talked about up until this point in the class has been a known liability. We just simply weren't specifying that it was a known liability. And now we'll show the difference between known versus unknown or estimated or contingent type liabilities. That's what we'll cover in the second half of this chapter. But for now, we're looking at known liabilities. Known liabilities are simply the types of liabilities that we've been looking at already. A known liability means we know who we have to pay, when we have to pay them, and how much. So some examples are accounts payable, sales taxes payable, unearned revenue, short-term notes payable, payroll liabilities, and then multi-period known liabilities. And we'll look at all of these as we move on. Some of these are not new, but then some of these we're going to add some additional things to them. For example, we'll spend a lot of time on payroll liabilities because there's a lot of additional taxes and things that go into payroll. It's not simply looking at salary. We're looking at taxes, whether they're taxes withheld for the employer or withheld for the employee, or if it's a tax that the employer has to pay in order to be able to have employees. We'll also look at any type of withholding that employees have that ends up being a liability on the employer's side. So let's dig into these. The first thing that we're going to begin looking at is a sales tax payable. So anytime a company makes a sale, they can choose to include the sales tax in the sale of that item. And when they do that, they're going to get additional cash from the customer. But what's important is that additional cash from the customer is not for the business to hold on to. That business has done a service to the customer. Rather than that customer having to keep track of their sales tax that they owe on their own, the company collects it for them, but as soon as they collect that, they have a liability to the government to pay that sales tax to the government. So let's look. We have an example where Home Depot sold materials for $6,000. And these materials, in whatever state they're in, have a 5% sales tax. So the sales revenue is $6,000. However, when the sale was made, they collected the $6,000 plus the appropriate portion of sales tax. 5% of $6,000 is $300. So in total, Home Depot gets cash of $6,300. What's very important is that this extra $300 is not revenue. Instead, this is money that Home Depot has collected from their customer. and they have collected it based on the understanding that while that money is in their hands, they are liable, meaning that they have the obligation to remit this money to the government on behalf of the customer. So they have sales of $6,000, and then they have a liability. Remember, a liability increases with a credit, and that's why we're crediting this liability here. And the liability is simply our sales tax payable. This will remain a liability until this money is sent off or remitted to the government. Next, let's talk about unearned revenues. We have briefly introduced unearned revenues when we talked about adjusting entries early on in the class, but now we're just going to go over those again. So we have an example. We have a performing artist, and they have sold $5 million worth of tickets for 8 concerts. Now, if you'll think about buying tickets for a concert, typically people have to buy tickets in advance. They buy it through Ticketmaster or from the performing artist's website. Wherever it is they buy those tickets, they have paid for something in advance. When a customer remits their money for a ticket, that ticket or the payment represents an obligation that the performing artist has to fulfill their responsibility. So, on June 30th, when these tickets were originally sold, the performing artist gets the cash of $5 million. However, they have not yet had a concert. So this is a liability until they have earned that money. Again, we increase a liability with a credit, and we call this unearned revenue, and in this case it's unearned ticket revenue. Then you can see we had 8 concerts. So if we just assume these are going to be divided equally between the 8 concerts, that means that we got $5,000 worth in ticket money, divide that by 8 concerts. So as we have each concert, we will be earning this portion, or 1/8 of the $5 million. So when we perform our first concert, we now need to show that we have fulfilled that portion of the obligation. We haven't fulfilled the full $5 million worth of tickets, but we have fulfilled 1/8 of that, or $625 worth of those tickets. So we need to get rid of the liability, unearned ticket revenue. We do that with a debit. And we have now earned that revenue. So you can see here we credit ticket revenue for the same amount. But until we have earned the revenue, it needs to sit as a liability. Because if for some reason a concert is canceled, there is the legal obligation to somehow make things right for these ticket holders, whether you reschedule a concert or if you give them their money back. But there is a legal obligation, and we show that there with that liability as unearned revenue. So what about if we have a multi-period known liability? The basic example of this is our unearned revenues and notes payable. So if you think about the previous example, we had 8 concerts. If those 8 concerts spanned 2 different years or 2 different accounting periods, that would be a multi-period known liability. Another classic example would be, for example, a magazine subscription. A customer pays for a magazine subscription, and that subscription is typically for a year. If you think of a magazine, it could be a weekly magazine, or to make things easy, let's say it's a monthly magazine. We would show the earning of that revenue once the magazine is sent out each month. So that's the same thing we were doing back here with the concert. Every time a concert is performed, we would show the earning of that revenue. And if these concerts or the obligation happens to span 2 different accounting periods, we would need to make sure we have everything up to date so that we properly show what our liability is and what we have actually earned as of the end of that accounting period. Next, we'll talk about a note payable. Remember, a note payable is a liability, and it's simply a liability that is typically more formal than an account payable. And we typically owe some type of interest. Oftentimes, a note payable is for longer than a 1-year period, so therefore it's typically a long-term liability. However, we would need to show each year what interest has been incurred, therefore what is payable and what has been paid. So we're going to be needing to update that every time we close the books. So we would need to adjust the books for the interest related to that note payable. So next, let's talk about a short-term note payable. As I mentioned, in general, oftentimes when you talk about a note payable, you typically think of a long-term liability. However, that is not an exclusive rule. You can have a short-term note payable, meaning that it's simply for less than a year or less than an accounting period. So maybe it's a 9-month note payable. Or you could have a long-term note payable that includes installment payments, meaning that you don't wait until the end of the payable to make one payment. Instead, if it's an installment type note, you make payments as you carry out the length of the note. And if any of those payments are due within less than a year, that portion that is due or coming due within less than a year needs to be classified as short term because we need to pay it in less than a year. So the basic definition of a short-term note payable is a written promise to pay on a specified amount on a defined future date within 1 year or the company's operating cycle. So that's our basic definition of that note payable. So here we have an example of a note given to extend a particular credit period. So in August, a company asks someone that they have purchased something from to accept $100 of cash and a 60-day 12% note payable. And they're doing this because they have an existing account payable that they're not ready to pay on. So let's look at here. What's going on is they have an account payable. They are supposed to go ahead and make this right or make this payment, but for some reason they're not able to do that. So what they're doing is they're asking if, instead of accepting the full $600, they're asking if we would accept the following. Will we take $100 of cash, and in return, we will put together a formal note payable saying that we still owe you $500. We're going to make it formal. We're going to put a contract with it because remember, an account payable typically doesn't have a contract. It's not as formal. Not only that, are we going to sign and say that we do owe you this $500, but we're also going to pay you 12% interest for these additional 60 days. So let's see how we record this. First, we are going to say that we no longer have the account payable with this customer, so we need to fully write off this account payable liability. It doesn't mean that we are not going to get the money from them, but it means instead of classifying it as an account payable, it's going to be a note payable. So you can see here, we write off the account payable, you decrease a liability with a debit here, and then you can see what did we give them in exchange. We gave them $100 of cash, so we pay the cash here. You can see we're crediting cash, and now we have a note payable. It's simply a more formal version of the account payable that we did have. So we show the increase in the note payable, showing that we have this new classification of a liability for $500. Now you can also see we also promise that we are going to pay 12% interest for this $500 that remains outstanding. So as time passes, we'll have to show the incurrence of that interest and then the payment of that interest. So here we have 2 months later, we're going to pay the note payable back, and we're going to pay the interest. So go ahead and calculate the interest expense. This is just the same way we've been calculating interest. $500, because the note is only for $500. It wasn't the original $600. It's $500 multiplied by 12%. Remember, when we're given a percentage, that's an annual percentage rate. And because this was not outstanding for a year, we need to multiply it by however long it was. So it was outstanding for 2 months or 60 over 360 days. You could also say 2 over 12, whatever works for you. That gives us interest expense of $10. So we pay back the note payable, so we get rid of the entire note payable, $500. We go ahead and we record the interest expense that we have now incurred, $10 of interest expense, and then we pay the cash that was owed the cash that we pay is going to be the principal plus the interest, so $510 here. Here we just have an example of a note given. You can see here it's an example of a promissory note. You can see we've got the face value, the definition of the days that you promised to pay, the rate and the specific dates, and then making a legal contract. You sign who you will pay it to. Again, these are just some typical terms that you'll need to be familiar with. So let's look at another example. This is where we give a note in order to borrow money from the bank. So on September 30th, a company borrows $2,000 from the bank at 12% interest. So we go ahead and show that we got cash from the bank, and we have now incurred a liability, and that's a note payable for $2,000. Now, we have time that has passed. 2 months have passed, so the 60 days or so have passed, and we're going to repay the note and the interest. This is very similar to what we did on the previous slide. The interest is $2,000 multiplied by that annual percentage rate of 12%, multiplied by 2 months out of the year. So that gives us $40 in interest. We pay off the note payable for $2,000. We record the interest that we have now incurred as an expense, and then we pay the principal plus the interest of $2,040. So what happens if we have a period that ends before a note has been fully paid? So what we're saying is that we end the year or end whatever accounting period we have, and we have incurred interest, but that interest has yet to be paid. This is very similar to what we looked at when we had a receivable, when we were on the receiving end of the interest. We need to go ahead and accrue the interest. So in this case, we need to accrue the interest expense. And then when the maturity day hits in the following year, we will go ahead and accrue any additional interest that has been incurred between the end of the previous year and the maturity date. So we're now going to move into looking at payroll liabilities. So when we're talking about payroll, we're talking about making journal entries as if you are the company who is paying your employees. So that's the perspective that we're looking at. So we're going to look at the liabilities related to payroll. We're going to be talking about the liabilities that we incur because we withhold certain things on behalf of our employees. And then we're going to talk about the liabilities simply related to our payroll expense. And these are the taxes that we have to pay as a business to the government. And these are expenses that we incur. So first we're going to concentrate on the liabilities that we incur because we withhold things on behalf of our employees. So let me just go ahead and explain what's going on here. You can think about your own paycheck here. When you get your paycheck or your pay stub, you'll see that you have a gross pay that's, say, $2,000. But then your net pay is the money that actually goes to your checking account, and let's say that that's $1,500. So what happens? What is the difference between the $2,000 gross pay and the $1,500 net pay? Those are our employee payroll deductions. Note I'm saying employee because this is the payroll deductions that an employee has withheld from their check, and then these deductions are deposited to the various places based on the company's liabilities. So you can see here a company will withhold certain things from a company's gross pay. And when they withhold these things, this is money that is owed to the employee. However, they're doing a service for the employee by withholding these items. And you may be thinking, well, how is it a service if you withhold money from me? It's because no matter whether or not the company withholds this and pays it on your behalf, or if they go ahead and give you 100% of your gross pay, you would still have to pay these items. So it doesn't matter who pays it, it just has to be paid. So to make things easier for their employees, what a company will do, they will withhold certain items from the employee's paycheck, and then they will remit that withheld money to the appropriate places. So, for example, two of the main things are your income taxes. Now, this is something that you as an employee owe to the government. But rather than you having to actually make those payments to the government every time you get a paycheck, luckily most employers do that for you because that can be a fairly complex and difficult thing to be able to calculate properly. So your company has a payroll department who does that, and that is their job, and so they do that for you. They make those calculations, they withhold the money, and they send it to the government on your behalf. Now, if your company did not do this for you, you would still have to do it. So no matter what, these taxes would have to be paid. But when your company withholds these taxes for you, as soon as they withhold them, meaning they don't give that to you in your paycheck, they have a legal obligation to remit this money to the government on your behalf. So this withholding becomes a liability because this is not cash that your company gets to keep. It is cash that they are holding for you, and they are legally obligated to remit it or pay it to the government for you. Then we have some other type taxes. We have our FICA taxes. That includes both Medicare and Social Security. And then we also have any voluntary deductions. So these are deductions, let's say that you choose to give $5 per paycheck to United Way. They will withhold that for you, but as soon as they withhold it, they are legally obligated to send it to whoever you have determined is supposed to get that money, if it's United Way or some other type of charity. You could also have deductions for various health benefits or additional insurance, and you could also have retirement type benefits. Maybe you're withholding money to go into your 401k, but no matter what, as soon as that money is withheld, meaning it's part of your overall salary, but you don't get it in your paycheck, therefore it is withheld, your company has a legal obligation to pay it to the appropriate place for you. So let's look at how this actually works. We've talked already about income taxes, whether they're federal or state income taxes. The percentage is going to vary based on your income or whatever state you're in. But then we can talk about our FICA taxes. That's Medicare and Social Security. These are federal taxes, so the same rate is going to apply no matter what state you're in. These rates change each year, so right now we're looking at what the 2014 rates were. Typically these rates increase, but let's go ahead and look at 2014. The Social Security rate was 6.2%. Now this rate is limited if you make more than $117,000 in a year. Only the first $117,000 is going to be taxed, this Social Security tax. So anything you make over $117,000 is not going to have the Social Security tax. And then we have FICA. It doesn't matter how much money you make. You could make $1 million a year, and all of it is going to be taxed for FICA for Medicare, and that's at 1.45%. So these make up our FICA taxes, Social Security, and Medicare. I can go ahead and tell you, you as an employee have to pay these taxes. However, your employer also owes these taxes. So the federal government gets these taxes based on your wages from you, and they get it from your employer. And we'll look at those employer type expenses in a minute. But we're talking about the employee, or you as someone who works and receives a paycheck. You have to pay these taxes. So again, just like your income taxes, your company typically will withhold these for you, and as soon as they withhold them, they have the legal obligation to pay them. We've already talked briefly about income taxes, so these are just amounts that a company withholds on behalf of their employees, and then they'll remit to the appropriate agency. We also talked about voluntary deductions, and these can be things like whether it's certain charities, union dues, premiums, things like that. These are things that an employee voluntarily selects to have withheld, but however, whenever the company withholds that on behalf of their employee, they have the legal obligation to get it to whoever the employee wants that money to go to. So let's go ahead and look at how we make these types of transactions. So if we have someone that we need to pay, or if this is our overall payroll, if the gross payroll is $2,000, we'll need to go ahead and show a full payroll or salary expense of $2,000. Then we'll need to calculate whatever withholdings we need to make. So you can see here are our FICA withholdings, Social Security and Medicare. You can see these percentages here. And then we have the various income taxes payable. These are based on whatever rate is applicable to the specific employee. We have their medical insurance. This is one of those voluntary deductions. And then we have union dues. These are voluntary deductions. So all of these things, $124 for Social Security taxes, $29 for Medicare. You have income taxes for the federal income taxes of $213, insurance of $85, and $25. This is all money that is being withheld from the employee's paycheck. So when they get a check, the gross amount was $2,000, but what is actually going to be deposited into their checking account is $1,524. Now you can note that all of these items that are withheld are shown as a payable because this cash did not go out yet. This cash is still in the hands of the company because they did not pay it out in a check to their employee. So until this cash leaves the company, these are going to remain as these various payables until they remit this cash, for example, to the Social Security Agency or to the federal IRS for the income taxes. So these are all liabilities until they are paid. Now let's talk about payroll expenses. And these are expenses that the employer incurs. These are not taxes that are going to be withheld from your employee and then paid to the appropriate agency on your employee's behalf. These are expenses that are simply expenses related to having an employee. We've got lots of different examples of expenses. The most basic is our employer payroll taxes. So we talked about FICA already. We have Social Security and Medicare. Remember, both the employee and the employer pay these, and they pay the same exact amount, so those percentages are going to be the same. And then the employer also has another type of tax. That's the federal and state unemployment taxes. These are taxes that employers have to pay, and it's part of the cost of employing someone here in the United States, and it goes to unemployment. So if someone is laid off or something, the money that has built up in unemployment taxes, that's where that money comes from to help people in between jobs. So again, this is just simply it's just an expense of having employees here in the United States. So we've already talked about these unemployment taxes briefly, and you can see here we've got various rates that go with each of these for federal unemployment and for state unemployment. You can see here 6.2% and 5.4%. Now these taxes are only paid on a certain portion of each employee's wages, and right now it's only on the first $7,000 of an employee's wages. So companies have to pay these taxes in order to be able to employ someone. You can see here the journal entry for these related expenses. You can see here we have a payroll tax expense. This is not simply a salary expense, it's a payroll tax expense. And it is an expense that you have to pay in order to be able to employ people here in the United States. We've got FICA taxes here, and we've got our various unemployment taxes. And you can see again that these are all payables, and they will remain payables until this money actually is paid to the government. At that time, you would reduce the payable, and then we would show the cash being paid. So moving forward, we're now going to look into our estimated liabilities. And we call this an estimated liability because that's in comparison to what we've been talking about, which was a known liability. An estimated liability has some element of unknown, whether it's who we pay, when we pay, or how much we're exactly going to pay. So let's go ahead and begin looking at what these estimated liabilities are. So by definition, an estimated liability is a known obligation. So we know that there will be an obligation, but it's of an uncertain amount. So we don't know exactly how much it will be, but we can get a reasonable estimate. One of the best examples are our health and pension benefits. So if you're an employer and you provide health or retirement benefits, you know that you're going to have to fulfill some obligation. However, we don't know exactly what our medical insurance expenses are going to be, or exactly how much someone is going to pay into a retirement program. If we agree to match it, we would have some type of expense related to those payments. And again, we don't know exactly how much those are going to be. However, based on the matching principle, we need to go ahead and recognize these expenses in the same period in which these types of salaries or this work that these people were doing helped us to earn revenue. So we have to base this on an estimate. So we don't know exactly how much, but we can have a reasonable estimate. So you can see here we've got an example. We see that an employer agrees to pay an amount for medical insurance equal to $8,000, and then they will contribute an additional 10% of an employee's gross salary to a retirement program. So you can see here, this is not a salary or a payroll expense. Instead, this is a benefit expense because this is related to health and retirement type benefits. So you can see here, employee benefit expense of $20,000, employee medical insurance payable $8,000, and then $12,000, which is 10% multiplied by their salary for the retirement program payable. And again, these are liabilities because we have the legal obligation based on our contract with our employees. When someone has done work for us and they have therefore earned these contractual benefits, we have the legal obligation to pay them these benefits or to remit this to the appropriate agency on their behalf. So this is going to be a payable until we make those payments. So then let's talk about vacation benefits. Typically, companies offer a vacation. However, this is another unknown type of liability or estimated liability because even when someone is provided vacation, they don't always take every single moment of that vacation. So let's look at an example here. Assume that an employee earns a little over $20,000 per year, and they earn 2 weeks of paid vacation per year. So you can see here we can calculate how much they're getting for that paid vacation. You can see here, typically a year has 52 weeks, but if they're only having to work 50 of those weeks, you can see dividing by the two different amounts, you can see the difference in their weekly pay. And you can see here the difference here is $16 of weekly vacation benefit. So we would go ahead and book that as a vacation benefits expense and then vacation benefits payable. As someone then takes their vacation, we would reduce the payable and show that that benefit is being paid. So now let's talk about a bonus plan. Again, this is an estimate because we can reasonably estimate an amount, but we really don't know the exact amount that someone's going to earn until the year has ended or we begin to go back and look to see whether or not someone has earned their bonus. So in this case, we have a bonus that is going to be paid to employees equal to 5% of the company's annual net income. So we have to go ahead and book this expense. You can see here how we book that. We calculate it 5% multiplied by 21,000 minus the bonus. You're asking why we do this? Because remember, it's the company's annual net income. If they made net income of $210,000, that's their net income. But this amount does not yet include one important expense, and that expense is this 5% bonus. So we have to include the bonus here. we can solve for that, and you can go through this following equation here. But in the end, our bonus is $10,000. So we book employee bonus expense, and then that bonus payable. This is going to remain a payable until it is actually paid. So now we're going to talk about a warranty liability. If a company sells a product and they offer a warranty, that's simply some type of promise behind the quality of that product. They're saying that we believe our product is of good quality, and because of that, we're going to add a warranty, saying that if something does go wrong, we will either fix it or replace it at our own expense, so at the expense of the company who sold the product. So when we sell a product along with a warranty liability, you have to recognize the possibility that there would be an expense when someone comes and they ask you to fulfill your warranty promise. Again, based on the matching principle, we want to match our expenses in the period of the revenue that they helped earn. So let's think about this. If we sell something in 2014 and it had a 2-year warranty, and let's say sometime in 2016 their item broke and they actually come back and they ask us to fix it. Is that expense of fixing that product related to 2016, or is it related to 2014? Well, based on the matching principle, we would say it's related to 2014 because this expense that we are now incurring helped us to earn the revenue. Because typically when a company offers a warranty, they're going to advertise that this is a product that has a strong warranty that backs up the product. So they're going to advertise it as being a strong product, and therefore being able to add the warranty to the advertising helps you to make the sale. So anytime we sell a product that has a warranty attached, we want to go ahead and estimate what we actually think we will have as an expense due to these warranties. Again, we don't exactly know how many warranties we will have to fulfill, and we don't know the exact cost, but what we can do is we can come up with an estimate. We do that by looking at our past experience. So let's look here. On December 1st, 2015, a car dealership sells a car for $16,000, and it has a 1-year warranty or 2,000-mile warranty that covers parts. Based on the company's past experience, they find that they typically have warranty expenses of about 4% for their sales price. So as soon as we make this sale, we need to record the revenue for this sale, but we also need to recognize any expenses related to this sale, and in this case, we have a warranty expense. 4% of $16,000 is $640. So we recognize warranty expense. This is a debit just like any other expense. And this is an estimated warranty liability. Make sure you include estimated warranty liability to remind us that we don't know exactly how much we'll end up having to pay out. We may pay more than this or we may pay nothing. It just depends on whether or not a customer comes and asks you to fix something. So we have that estimated warranty liability of $640. This will remain a liability on our books until one of two things happens. Either the warranty period expires, meaning that the 1 year or 12,000 miles expires. If we didn't have to pay anything, then we would end up getting rid of this liability. Or if we do have to pay something, we would make adjustments to this estimated warranty liability. Let's say that we end up a little while later have a customer and they return for car repairs, and those repairs are related to our warranty promise, so these repairs are an expense to us. This is going to be a $200 warranty liability. But let's go ahead and look. How do we actually calculate this? Remember, we already recorded the expense, and we did that back in 2015 when we made the sale. So we don't recognize that expense again because the expense is not relevant to January 2016. It was relevant when we made the sale. So how do we record this? First, this $200 we now know is a warranty that we're going to have to pay. So we need to remove it from the estimate because it's no longer an estimation. So we remove the estimated warranty liability because we're now fulfilling an obligation, so we take that away. And then we have our various assets that are decreasing. If we simply had to pay cash, we would show a decrease of our cash here with a credit. But in this case, we had to provide some work or some type of parts inventory. We had to replace a part. So you need to show the decrease in that auto parts inventory for the $200. Now we're going to move into what we call a contingent liability. And just like our estimated liabilities, a contingent liability is a type of unknown liability, meaning that we don't know exactly who, what, where, how much we're going to have to pay. There's some unknown element as opposed to this being an unknown liability. So what is a contingent liability? A contingent liability is something that we know we may have to pay in the future, but we may not know 100% if we have to pay it, and then we don't know exactly how much we have to pay. So let's talk about how does this happen. The classic example of a contingency is if you have a lawsuit. If you're a large company, you typically at any time have some lawsuits that are typically going through the legal process. So when we have a lawsuit or any type of contingent liability, first we have to determine the probability of this liability. Then once we do that, we have to be able to determine the amount. So based on where this liability or this contingent liability is classified, we may or may not have to record the liability. When we record a liability, that's simply where we show the liability on the books, meaning we actually make a journal entry to show that liability. Or maybe we just have to simply add a disclosure in the notes of our annual report. Or there's also times when no disclosure is necessary. We don't record it, we don't disclose it, we just keep quiet about it. So let's talk about these. We first have to determine how likely it is that the event will take place. So again, if you're thinking about a lawsuit, what you would do is you would go to your legal counsel and say, okay, we have this liability, someone's suing us, let's say that we're a car company and maybe something we did caused a crash. And we are being sued. So you can ask your legal counsel, what do you think is the outcome? Is it probable that we will lose the lawsuit and therefore we will have this liability? Is it possible we will lose the lawsuit and therefore have the liability? Or is there a remote chance, meaning most likely we will win? And if we win the lawsuit, we won't have to pay anything. So these are the possible outcomes. Really, if you're talking about something being possible, you're talking about kind of a 50-50. It could happen, it couldn't. But then if it's probable, that means it's more likely than not. Or if it's a remote chance, it means you are most likely going to win and therefore not have the liability. So if there is a remote likelihood, meaning that you will most likely win and not have a liability, you do not have to make a disclosure. But then, if it's probable or possible, there's the possibility that we need to make a disclosure or record this as a transaction. So let's talk about this. If it is possible, we will go ahead and disclose it in the notes. However, if it is probable and we can estimate the amount, we need to go ahead and record it. However, if it is probable but we cannot estimate the amount, we'll simply add a disclosure. And that's because anytime you make a journal entry, you have to show the accounts and you have to show the dollar amount. So if your legal counsel says, yes, you're likely going to lose this lawsuit, so you will have to pay some type of liability, but we have no idea how much it could be. It could be $10 million or it could be $100,000. We cannot estimate. If you can't have an estimation, you can't make a journal entry because you can't make a journal entry without a dollar amount. So in this case, you simply disclose it in your notes. If you can estimate it, we go ahead and record a transaction. So again, the examples of a contingent liability is a potential legal claim. This is where we're talking about some type of liability through the legal process, you're being sued for some reason, or if you have some type of debt guarantee. These are contingent liabilities. So finally, we're going to end the chapter talking about a ratio related to our current liabilities. And this ratio is the times interest earned ratio. The way we calculate this is we take our income before interest and income taxes and divide that by our interest expense. What this is telling us is what income do we have available to pay the interest expense that we're incurring in the current period. The reason that we use income before interest and income taxes is because this is the income that is relevant to paying our interest expense. Because we want to make sure that we're not including the bottom line income, because that's going to be after we've paid interest and after we've paid taxes. But we're looking at, can a company pay the interest that they are incurring in the current period? So you're only looking at the income before interest and income taxes have been taken out, because that higher number in your multi-step income statement is going to be the number that is relevant to whether or not you're able to pay your interest expense. So that's our time interest earned ratio.